Any successful business will need to seek new outside capital in the form of debt and equity at some point in its life cycle. Debt typically comes in the form of things like loans or lines of credit from banks or other financial institutions. Equity, on the other hand, represents the sale of shares of stock in the business to outside partners. Historically, debt has been regarded as preferred to equity because it has certain advantages. First, there are lots of financial institutions from which you can source debt. Banks, for example, carry loans on their books as assets of the bank and compete to make these loans. Second, with debt, there is no dilution of the owner's stake in the business. And finally, for small businesses with revenue under $26 million in the last 3 years, debt interest remains fully tax deductible. Some disadvantages of debt? It must be repaid on time, and the lender will require and enforce covenants. Covenants are agreements on the uses of the loan's funds, the business's access to other source of capital, and the business meeting certain financial goals during the terms of the loan. Equity capital offers its own advantages. The amounts that can be raised are usually in excess of what can be borrowed as debt. There are fewer restrictions on the use of funds received, but there are disadvantages of equity capital too. The original owner's share of the business is diluted with the sale of stock to outsiders. The sale of stock is closely regulated at the federal and state levels and can put restrictions on the number of investors, their degree of sophistication, the number of equity offerings, and the amount that can be raised in a given period of time.
Deed has partnered with the law firm of Fox Rothschild to publish Raising Capital's Securities Law and Business Considerations, which serves as a primer on these and other issues related to debt and equity. It is available free of charge online at the Small Business Assistance Office website.